Chapter 15, we're going to talk about financial statements, the balance sheet and the income statement, and a couple ratios. So it starts with the income statement, and here is the basic setup of an income statement. So we have our gross sales minus returns, if there are any, gives us our net sales, minus our cost of goods sold. And our cost of goods sold is over here, it's calculated by how much did we have in our beginning inventory, plus our purchases of this product, including any freight charges, minus our ending inventory. So if we're a retailer, we're always starting with something, we add to it, and then we subtract out what we're left with. The assumption then would be whatever we're not left with, we must have sold. Whoops, sorry. So that goes to our cost of goods sold. So then our net sales minus our cost of goods sold gives us our gross profit. Then from our gross profit, we're going to subtract out our operating expenses and our income taxes to get down to our net income. And when we analyze the income statement, there's two different methodologies to do it mathematically. One is a vertical analysis and one's horizontal. So vertical, we're going up and down. So we take every single line item in the income statement and we divide it by our net sales, and it gives us a decimal, which will turn into a percent. So we're saying, what is this as a percent of our net sales? So what is cost of goods sold as a percent of net sales? What is gross profit as a percent of net sales, etc. The horizontal analysis, the horizontal analysis goes from last year to this year. So at first we calculate the dollar amount of our change. So did it increase? Did it decrease? Whatever that difference is. And then we always want to divide it by the prior year, because we're always saying, did it increase from last year? We're always making a comparison to last year. And that too will give us a percentage. So here they show us the example. So again, if we're going up and down, we're going vertical, we take each line item, divide it by net sales. So as you look at that denominator for every line item, it's the exact same amount because it's all net sales. And then we calculate out a percentage. Horizontal, again, we're going left to right. So we say last year is the 2015, this year is 2016. We decreased, and then we take the dollar amount of that decrease and divide it by 2015 to get the percent. Same thing, each line. To take the difference, again, it's a decrease, divided by 2015, the prior year, and get a percent. These are really nice to do these in Excel. I'm not going to have you do that, but just the mathematics of it is like redundant. It's the exact same formula over and over, so those make it nice to do in Excel. Okay, then our balance sheet, again, you've got to understand our balance sheet. So it goes back to our accounting equation. It's our assets are equal to our liabilities plus our equity. Assets are things that we own. Current assets are things that are going to be converted into cash within 1 year. Property, plant, and equipment are, again, our tangible fixed assets that are going to last more than a year. Liabilities are things that we owe or debt that we're going to repay. Current liabilities will pay that debt in the current year. Long term, it's going to be paid off longer than a year. And then our equity is basically what the owners have invested and left in the company. So here's an example of a balance sheet. So again, we've got our current assets listed in order of liquidity, how quickly they're going to turn into cash. Our other assets, which are property, plant, and equipment, things that are more long-term. Then our liabilities are things that we owe, so our payables and other current liabilities are long-term debt. And then finally, our stockholders' equity. And then how we analyze it is the same way as the income statement. We do a vertical analysis and a horizontal analysis. So the mathematics of that is you take each line item in the balance sheet and divide it by your total assets. So the denominator for all line items will be the total assets. And again, that'll give us a decimal that will turn into a percent. So what is cash as a percent of our total assets? What's inventory as a percent of our total assets? The horizontal goes from left to right. So we always calculate what is our change from last year to this year. And then we divide it by last year or the prior year, and that too will be a percent. So I don't think I put an example in there, but again, look back to your book because your book will have a nice table that's set up like that. Then the ratios that we do from our balance sheet are our current ratios, which is our current assets divided by our current liabilities. And the textbook says it's, best to have that at 1-to-1. Anything more than that would be better. Less than that's going to be riskier. Our asset test is our liquid assets. So basically, our liquid assets just simply takes out inventory. Because if we have accounts receivable and cash, accounts receivable are what our customer owes us, so they're going to pay us pretty quickly. And then our cash is already cash. Inventory, you got to sell it and then collect it. So again, that can take longer. So it's not considered as liquid as the other current liabilities. And the textbook says that too should be 1-to-1 to be safe, to be able to pay your bills on times. Our return on equity is our net income divided by our average equity. And our average equity we would compute by taking the beginning balance plus the ending balance and divide by 2. So we'll have to do that little bit of math first, then divide that into net income. And the higher the better. The textbook again says we could compare that to what people are getting paid on government bonds. So if you're making 3% on a government bond, your return on equity should be more than that. It should be 5% or 7% because it's definitely more risky than a government bond. Okay, so that's our basic analysis and basic math of computing the analysis of those statements.